If you've ever felt like building long-term wealth is some kind of exclusive secret club with its own super complicated language, well, you definitely aren't alone. Today, we're cutting right through all that noise. We're looking directly at the sources, from the SEC to major investment firms, to unpack this explainer. Think of it as your ultimate blueprint for smart investing. So here's a question for you. How exactly do you turn $10,000 into over $100,000 without literally lifting a single finger? I know, it sounds like a massive exaggeration, right? But the truth is, the most successful wealth building is actually incredibly boring. It happens quietly, right in the background, just by harnessing the raw mathematical potential of long-term passive growth. And the magic number behind that growth? 7 to 10%. According to historical averages, that is the estimated annual return for long-term, diversified investments in the US stock market. Now, obviously, you won't get that every single year like clockwork. Markets are volatile, that's just their nature. But over decades, that historical trend is the absolute ultimate tailwind you want pushing your portfolio forward. To capture that tailwind, here's the roadmap we're going to follow today. We'll cover saving versus investing, the magic of compounding, building your toolkit, strategies for smart returns, avoiding rookie mistakes, and finally, protecting your future. All right, step one, saving versus investing, knowing the difference. It's absolutely crucial to distinguish between just parking your cash and actually putting your money to work. The SEC actually draws a really distinct line here. On one side, you've got savings vehicles. Think CDs or savings accounts. These offer FDIC insurance and principal protection, which is perfect if you need short-term liquidity. But there's a catch. The yields rarely outpace inflation, which means you're technically losing purchasing power over time. On the flip side, investments carry inherent market risk, sure, but in exchange for taking on that volatility, you unlock the opportunity for those compounding, inflation-beating rewards we all want. Which brings us to part two, the magic of compounding, or as I like to call it, your wealth snowball. This is the real core engine of smart investing. So what is compound growth exactly? At its core, it's just earning a return on your invested capital, as well as on the returns that capital has already generated. We've all heard the snowball analogy, rolling a tiny snowball down a long hill until it's massive. But seeing the actual math play out over decades is just staggering. It's the literal difference between linear, slow accumulation and explosive exponential growth. And the formula? It is incredibly simple. Regular investments plus time. But time is the real heavy lifter here. Think about it. If you set aside just $100 a month for 40 years, you aren't just getting back your initial $48,000 in principal. Thanks to compounding and assuming those historical market returns we talked about, that capital geometrically expands into hundreds of thousands of dollars. It's wild. Let's move into section 3, building your toolkit and identifying those core assets. The foundation of any really smart investing strategy requires balancing equities and fixed income. Equities, or stocks, drive your portfolio's growth engine and offer potential dividend yields, but you've got to have the stomach for higher volatility. Bonds, on the other hand, act like your anchor. They are basically a loan you make to an entity, providing predictable fixed interest yield and preserving your capital to offset the turbulence of the stock market. To manage all that volatility, the classic 60-40 portfolio remains a gold standard benchmark, 60% equities and 40% bonds. This specific allocation is designed to let your equities do the heavy lifting for long-term growth, while the fixed income side acts as a crucial shock absorber whenever the economy takes a dip. Now, how do you execute this balance efficiently? That brings us to exchange-traded funds, or ETFs. Instead of doing the whole high-wire act of picking individual winning stocks, ETFs offer a highly efficient, super low-cost way to capture broad market returns. You buy a single ticker and boom, you get instant, massive diversification, virtually eliminating the risk of a single company tanking your entire strategy. Moving right along to section 4, strategies for smart returns. And we're going to focus specifically on the dividend approach here. For cash flow-focused investors, dividends are fantastic because they offer a predictable yield totally independent of what the market price is doing on any given day. Depending on your risk tolerance and how much time you want to spend on this, there are a few established paths. You can take a totally hands-off approach with broad dividend ETFs, or you could optimize for sheer quality with dividend aristocrats. If you prefer a more mechanical contrarian vibe, the dogs of the Dow strategy rebalances annually. Or you could go with a sector-balanced mix, which focuses on generating income across fluctuating economic cycles. Let's zoom in on dividend aristocrats for a second because it reveals a fascinating proxy for corporate resilience. We are talking about S&P 500 companies that have increased their dividend payout for at least 25 consecutive years. Think about that. These are blue chip staples that have survived the dot-com crash, the 2008 financial crisis, and global pandemics, all while making enough free cash to actually hike their shareholder payouts. It really is the ultimate quality-first strategy.
All right, Section 5, avoiding common rookie mistakes so you don't derail all this progress. Because let's face it, even a mathematically perfect portfolio can be absolutely destroyed by human error.
The greatest threats to your money are usually psychological. First up, herd mentality, chasing social media hype instead of looking at actual fundamental value. Second is the illusion of market timing, which almost always ends up with you buying at the top and panic selling at the bottom. Third is overtrading, which just slowly bleeds your compounding dry through endless fees. And finally, ignoring diversification. Putting all your eggs in one high-flying basket is just a recipe for disaster. There's an old adage that hits the nail on the head. Expecting quick returns often leads to disappointment. Wealth creation is a gradual process. Impatience is a massive, massive liability. True wealth building requires the emotional discipline to just sit on your hands and endure the volatility without liquidating everything the second the market gets scary. Which brings us to our final section, Section 6, protecting your financial future. Let's get into the execution plan. Now, if you decide to use a financial advisor, the SEC strongly recommends you vet them thoroughly. Demand total transparency. Ask them directly, are you a fiduciary? Are you earning commissions on the exact products you're selling me? What's the true total cost of your management? And honestly, never outsource your own vigilance. Always check your trade confirmations and call out any unauthorized activity immediately. Protecting your capital starts with you paying attention. So to actually execute on all this, here is a rock-solid 4-step checklist. Step 1, wipe out your high-interest debt. I mean, no ETF on the planet is going to safely outpace a 20% credit card fee. Step 2, build a liquid emergency fund so you aren't forced to sell off your investments when your car breaks down. Step 3, pick a simple, low-cost ETF strategy. And Step 4, set up automatic monthly contributions. Pay your future self first before your current self has a chance to spend it. We have covered a ton of ground in this explainer today, from the pure math of compounding to setting up defensive diversification. The math is proven, guys, and the tools are literally available to anyone. The only variable left is whether or not you actually execute. So the question is, will you start building your wealth snowball today, or are you going to let inflation quietly melt your capital away while you wait for the quote-unquote perfect time? Remember, the absolute greatest risk isn't market volatility. It's choosing not to invest at all. Thanks so much for joining me, and I'll see you next time.